Welcome, everybody, to the Hot Take of the Day podcast. I am your host, DRW, and today I am very excited to be joined by Billy Bailey. How are you?
Doing great, David. How are you doing?
I am doing great. So I've been following Billy sort of indirectly for probably a year, I want to say. And so today we're going to talk oil and gas investment, hedge funds, what's going on in Dallas, Braxis, and all forms of fun that have to do with investing in oil and gas companies, becoming an activist on boards, and what the future of energy looks like. So, Billy, why don't you give a brief introduction of yourself for those who don't know you from some of your more exciting press releases?
Sure. Well, I had a feeling you might ask some of those questions. I had to brush up on some of those topics. It's a dynamic thing that we'll get into, and I'm excited to be able to vocalize. And I can actually speak a lot more about it today than I would have been able to speak about it in months past. So I think that'll create an interesting topic, to say the least. But David, once again, I'm grateful to be asked to be on your show. I've been following you for longer than you've been following me. I'll say that my shoe game is not quite on par with what your shoe game is. And my background is one where I was born and raised in Dallas, Texas. My dad kind of jokes that he was the black sheep. He left Waco, Texas to go to the big city. He went to SMU. The rest of his family went to Baylor. My mom's a small town girl from Grand Prairie, Texas. And I kind of took a similar type approach to my father, and I was the first in my family to go to the University of Alabama. And I know that you've been writing a lot about Vicki Hollub. She's a proud Alabama alum. I'm assuming we will probably not get in that topic. Maybe we will. We'll see what happens.
Well, we have to now. I mean, I'll lead. That's what you did. You just opened that can of worms.
So maybe I'll just approach it on a football basis, which is what we tend to talk. We talk about national championships, less on the academic side. So that's what we're focused on from University of Alabama alums. But I was grateful to go there. I was between SMU and Alabama. I'm a diehard football fan, as I was alluding to. Went to visit Auburn first. And as a natural now Alabama alum, I didn't like my experiences at Auburn. Went to Tuscaloosa next, fell in love, gave it a shot. And I'm so grateful for that and the lifetime friends that I made there. Moved back to Dallas, and through persistence got an internship working for T Boone Pickens at BP Capital.
And what year was that when you started working with T Boone?
2009.
Okay.
So I can relate to a lot of the same stresses and anxieties that a lot of these undergraduates that'll probably be watching your show or have been watching it can relate to. Time actually ran an article, I'll never forget, about a month before my graduation that said, this is the worst time in the history of all undergraduates to be graduating from college right now to try to get a job. And I was thinking, well, that's an optimistic way to view things. And it was tough. I mean, and what I'd say, and it's really tough when you're a personality like myself that wanted to bypass investment banking, bypass the sell side, to go just directly dive into the buy side. And it took a lot of persistence, and it took not accepting no as an answer. So anybody that's listening, I would highly encourage you that if somebody tells you no, tell them, what does it take? I'll freaking sweep the floors. Just let me learn. And Mr. Pickens told me no about 8 times. Actually, right next to our office building is the T Boone Pickens YMCA. I snuck in there in 2009. It was being dedicated and renamed to the T Boone Pickens Y. And I snuck through the red tape and went to the front and stuck out my hand and said, Mr. Pickens, Billy Bailey said, Billy, I know who you are. Come to my office on Monday. He finally, and he said, look, and this is, David, we don't know each other too well. We've been following one another, but I don't ordinarily cuss, but this was his quote. He said, look, if you're not worth a damn, at least you'll have something to put on your resume. Start as an intern on Monday, come to the office. And so I just went in there, and I've heard you mention this before, but the first thing I did about the second week on the job is I did the math to figure out how many hours per day I had to work and how many years I had to be there in order to equate to the people that were senior to me on the investment committee. So I worked 16 hours a day, about 6.5 days out of the week, and just freaking grinded and absorbed and was a sponge. And it was an incredible experience because a lot of the similarities, and I know you've written a lot about this, comparing it to the 80s, a lot of the similarities and complexities that we're seeing in this market today really coalesce nicely with what Mr. Pickens saw. And we've been saying for about 3 years that we felt that it was, instead of just a simplistic 80s, we felt it was a blend between the 80s and the 90s, and more 80s top down and more 90s equities. And that's kind of how we've been describing this market for quite some time. So that's a little bit of the background. I'm passionate about the space. I love this industry. I love the people. It's not lost on me that there's troublesome times. We've been praying for everybody, and we're just excited to be on the show today.
So, I mean, there's so much to cover there. Now, I asked when we had Vicky on the Wenco webinar, and obviously with Alabama, I said, I'm not going to dodge any tough questions just because I like you. So we'll start with a really, really tough one, which is how are you going to function in the fall without Alabama football? Like, what are you going to do? That's like the lifeblood of the South, the SEC. I mean, come on.
You're literally giving me chills right now. Like, I'm not even kidding. Like, it is in the blood. I mean, this is like, we're going to be entering the dog days of summer, and I'm just a sports fanatic. And so when it starts to get like July timeframe is when I let my body actually go into, okay, football is around the corner. Let's go. And I've been reading and watching and what the AD's been saying. I've been watching what California is saying. I mean, I know California school system just came out and said that more than likely it's going to be internet classes throughout all fall, or that system. 5% of undergrads came from that system last year. So if that occurs, we're supposed to open up the season versus USC, and TCU is supposed to open up against Cal. So there's some murmurs going on that if California State shuts down, that we might actually play in Jerry World, which is the Dallas Cowboys stadium that Jerry Jones, obviously there's another topic on Comstock that could be touched there, but that he built. And so we might play TCU to start the season. There is so many unknowns. I mean, you've got people that are talking about testing before you go in, but to answer your question, it's going to be really tough. I've already been walking more than I've ever walked in my life with my wife. I've been going on jogs. I'm going to have to figure out some vice to get through it, because it's the saving grace. There's nothing better than when that football gets kicked off on opening weekend.
Well, Vicky said that she was going to just watch old tape games of Alabama. So no matter, like, they were going to go 17-0, they might go 34-0 if she could just watch those two games back to back. So, I mean, in a way, I mean, even if you're like a fan of the worst team in whatever sport it is, you can just go back to the archives, find all of the wins, just line them up, and then you're like, in baseball, you're 162-0.
I like that. It's kind of bizarre, but I've got just the way my brain works, I can recall a lot of those plays, a lot of those. I've been going through a lot of those games here recently, just rehashing them in my head, but so many good times. I mean, and look, you can't take it for granted. I mean, football is like energy. It's a cyclical sport. Thankfully, we've had arguably the greatest coach. We've had, two of the greatest coaches in the history of college football, Paul Bear Bryant and Coach Nick Saban. And you cannot take it for granted that for the past 13 years, what Coach Saban's done, and really, I know, some people are going to listen to this, they're going to think it's, funny, but a lot of the same things that he implements to his football team is what we take on a daily basis from a process and systematic approach. I mean, we have a very detailed process that we stick to.
Yeah.
And a lot of those same things that he talks about from an investing perspective are exactly what are implemented. And I've been saying for a long time, if Coach Saban wasn't a head coach in football, he'd be probably the best CEO that any public company could ever wish to hire. I mean, the guy is phenomenal. He's personable, and he's incredibly detailed, which are three very important traits for any leader.
So I want to circle back to that at the end, but you mentioned T Boone Pickens, and obviously a pioneer. Again, timing is everything, and when he sort of started his career and his push, was one of the first people to really push wind, as I recall. Just a really dynamic and interesting man, and you obviously got to work near him, know him. Do you got a favorite T Boone story you can share with us?
Gosh, there's so many, it's nearly impossible. A lot. I tell people that even though when I resigned, I was 29 years old, and he passed away last year, September 11th, 2019 at 91. We got to spend a lot of incredible time, and there are so many memories that come to the forefront of my mind when you ask that question. But what a lot of people maybe don't know because they just see him, he was really, really funny. And every single person, and it's part of the reason why I love this industry so much, every person that he came in touch with, he treated the exact same. And so I'd be on the set with him at CNBC before he'd be going on. And, we'd be in the makeup room or whatever. And he would always, like, the trick was that whoever's coming in to do his makeup, he'd always say, "How old do you think I am?" And he'd say, "All right, if you get it plus or minus 5 years, I'll give you $100." And so, like, every single time it was like this fun game. And it really just brought down the temperament in the room, and it made just very approachable. And he just always had a smile. Like, even if it was, the worst day, he had a pretty good perspective. When I say worst day, I'm talking about worst day in the financial markets. He had a good perspective that that's work, and then there's life beyond work. And, he told us over and over, though, I mean, he was incredibly devoted to his work. And one other story that I think is one of my favorites is we got to spend a lot of time at his ranch in Roberts County. He had 68,000 net acres in Roberts County. It was unreal. He knew every single tree. He knew every single stone. He knew every single plot of land. As you can imagine, he started building that, he started assembling that ranch in the 70s. And over time, it got larger and larger. And when he had his fourth divorce, I was also a young single man. And so on Friday mornings, we would come into the investment as ICMs. We'd come in, we'd be sitting at the round table, and it was always Mr. Pickens, and then there was an empty seat, and then I sat there, and then across the table was our head trader, and then a person that had been with them for 40 years. And it was just a team, right? We had been there for forever. And humbly saying, I was blessed to be the first hire in a decade for BP Capital in 2009, or I guess in 2010, when I went from being an intern to being a full-time employee. But Friday would come and he would say, "What's everybody doing this weekend?" And this is what he was single. I was single, and everybody would kind of be sitting there around the table, and they'd kind of look at me, and I'd be like, I mean, I'm not really doing anything. So he's like, "So who wants to go to the ranch?" So almost every weekend for about a 6-month period, I would go to the ranch with them, and we would just walk, and we'd watch football. We'd watch a lot of football. He had an incredible movie theater, and we would just talk about life. We'd talk about business. I would just literally ask him every single question from the 80s, from the 70s, from just trying to absorb as much as possible. That were some memories and some conversations that I won't share, but some things that are just incredible. But he's an iconic man, and somebody that, I think anybody going to get a job, the foundation that you lay in the first job that you get, or the second job, or the third job, like the money that you're making or whatever doesn't matter. It's the foundation. It's that platform that you're building for the rest of your career. And I'm grateful that he gave me a shot and a chance. And, I love him, and I miss him. And I wish in these dynamic markets we could go have dinner as well.
Yeah, it's really interesting that you talk about the first job. And I think it ties together nicely with your concept of 2009 was probably the worst job market ever until now. And there's a lot of students who are coming out, and obviously the world has changed. And so you talked about the parallels of the 80s and the 90s, but everything is so much more complex. The data is so much faster. You can create a social media brand out of nothing. You can create followers on Twitter. There's so much stimulation, and you have these students who are going to come out and have to build a platform, and that your first job is your most important job. And for me, my first job was at Anadarko. And I like you, I had gone through, it was a really tough time in energy. I think people forget that.
2000? When did you start at Anadarko?
I started in 2000.
Okay.
And so it was in Calgary, and obviously like the energy industry had been in decline since 1973. And I think that people really forget that. And then sort of 1985, and my dad had been an oil guy, and I always wanted to be in oil and gas. So there was no question that was what I was going to do. So I didn't even think about, like, was there going to be a job? I just assumed there was, because that's what my dad did, and that's what was in my blood, and that's what Calgary was. And I graduated, and there were no jobs. And it was a phase of consolidation. And, I went to the evening information seminar for BP, and I asked like 3 questions, and I didn't get an interview. Now, not surprisingly, because I was like critiquing their business model in the open forum. And I now look back and I realize how much cultural fit and like your tenacity of just going up to T Boone and saying, "Hey, eight no's, and he finally hired you. Anadarko, a lot of the managers in Canada and those that listen know this, like 6 or 7 of them were totally against hiring me. They were like, there's no way he's going to stay. He's going to leave quickly. He's going to rock the boat. And it was one VP that I had met who loved me. And he's like, don't really care your opinion. We're hiring him. And I finally, after 7 years before I moved down to the US, I was able to convince some of the managers who'd been sort of not in the DRW camp that probably it was a good decision. And I'm so fortunate for all of the things that Anadarko gave me in the first 10 years of my career, both the good and the bad. And resigning was hard, and I'm sure it was for you. So it would have been about 2016 that you resigned. So what did you go and do, and walk me through that resignation moment?
Toughest business decision ever made. January 15, 2016. I'd been praying about this for 2 years. And in about September, October of 15, so sorry, let me just rewind just a second. So I went from being a senior analyst on the team, small team, 5 on the investment committee, directly on the hedge fund. So we were the people that were working directly for the legacy commodity product, the equity hedge fund that coalesced between commodities as well as public equities. Mr. Pickens' private investments, which encompass 150,000 net mineral acres, some Mississippi lime operations as well, some non-op opportunities in the Delaware Basin, some operating opportunities in the Delaware Basin, some operating opportunities on his ranch. So what was unique about the experience is, as you can hear, you got to see the entire value chain, and you got to see the public and the private. And in 14, I went to Mr. Pickens. We had dinner at R&D, which is a good spot here in Dallas. And we sat down, and I proposed a strategic shift on a hedge fund we were managing. And this was a week before OPEC decided not to cut. So it's a week before the Thanksgiving Day meeting, when they shocked the markets, similar to what they did on March
7th. Yeah.
Well, I know you talk about the 7th. 7th is when Saudi cut the OSP. And yeah, I mean, it was the 5th, 6th, 7th, 8th, and 9th is the whole period of time, right? So the 5th, you had Saudi that comes out, and they said 1.5. That PO'd Russia. You had Novak that was back talking to Putin. He comes back into the meeting on the 6th. He basically says, deal's off April 1st. We're freaking ramping up as much as we want. And then they responded, like you were alluding to, that Saturday, and OSP prices come out, official selling prices for Saudi come out, which is something that the industry watches closely. And they dropped it to historical low levels, like $8 or $9 off of where Brent was currently trading. And like you've alluded to, I was sitting there waiting for 5 o'clock on Sunday, 5 o'clock Central Time, when the futures market opens up, and it was just mayhem. And I know you talked about how you told, I think you said that the house of the early people you could talk to at that point in time, or something like that. And
it was dark days in the Ramsden Wood house, and it was, yeah. I will never forget. I compare, and I know this is crazy, I compare that weekend to September 11th. Slightly different, but just in terms of the impactful, I'm sure the JFK assassination is up there with people too. But for those in energy, that weekend was the change of the tide. No matter what you thought the energy industry was before that weekend, it is totally different now. But anyway, so you were having dinner at R&D with T-Bone.
So he allowed me the opportunity to become a sole portfolio manager for a hedge fund. So I managed that through the downturn. We characterize this as a 6-year downturn so far. So it started June of 2014. You're coming on the 6th year. People kind of characterize it in, 3 separate years, kind of 2014, 15, 16, and then, 18, 19, 20. And so we look at it more just like this is a 6-year bear market for energy, and that's what it's been in. And the peak was June of 2014. So I started managing this hedge fund for them, and it was really taking what tended to be in the past was utilizing it to energy investing, and coalescing what I had been spending the vast majority of my time on, which was studying the specific publicly traded companies, and was diving into the bottoms-up approach. And so we have morphed over time into this belief that, commodity prices are essentially out of your control. It's the fun thing to talk about, but as Saudi has shown you, even, somebody that produces, now they're producing, 7.5, 8 million barrels a day, but somebody that typically produces 10% of the global market, or OPEC as a cartel as a whole, plus Russia producing, 35 to 40% of the global market, they can't even control prices. So if that's the case, then you can only fixate on what you can control. So we focus on the assets. We focus on the rocks. We focus on the capital efficiencies, the amount of cash that can actually be extracted from those hydrocarbons that you're producing on a section by section basis, meaning that when you boil down those assets, and I know you know all this stuff there.
No, but it's great. It's great context for everybody. So I love these conversations.
640 net acres. So when you think about a 10,000 net acre block, we're boiling that down into each section, and we're looking at it, each section on, is that an NPV positive project? And if you're putting $1 into the ground into a non-NPV positive project, then it, based upon math, it's going to cost shareholder dollars. So that formula was, kind of initiated in 2014. I was blessed to be able to manage through the downturn. I had positive performance when energy rolled over by 70%. And I resigned January 15, 2016. And the resignation was incredibly challenging, but it was because I also love the aspects of building a business. My family, if you study the family, my dad started businesses, my mom started business, grandparents, the whole 9 yards. We are a family of entrepreneurs. And I love the aspect of instilling and creating your own culture, which means that when you build a team, and there's 2 of us in the office plus a ping pong table, when you build that team, it's important that the mantra that we take every single day is that you got to stick the ego at the door. Put the ego at the door, come in with your freaking lunch pail, ready and hungry and willing to grind. And that I'm going to be changing the paper and the printer. And so, we also need everybody that's working here to have that same type of mentality. And that's how the team moves forward, is by that aspect of just grinding and not bringing an ego to it, because this is the most humbling business you could ever be in. I learn every single day how stupid I am, because when you're right, you could have been more right. And when you're wrong, you shouldn't have been wrong. And so there's no room in an office, in my opinion, for an ego, when you got to set the pride aside and just focus on the fundamentals. So when I resigned, I was actually doing a professional MBA course at SMU, and I thought I would be portfolio manager for him, also get my PMBA, and I'd love the academics as well. When I resigned, I'd finished 3 classes, and I dropped out to start Saltstone. You couldn't balance trying to do PMBA commingling with starting a company. But I hope one day to go back and do classes. I love it. I love school, and school is unlike the real world. In school, you get a A, B, C, D, or F, or whatever the letter is. In the real world, it's a totally different formula. So,
well,
that's background.
Egos are interesting because and I've been thinking about it, and it's a great experience as a younger person, coming right out of school and going to work for someone like T Boone, because he also, and I don't mean ego, I mean he's a character. He was very clearly the alpha. He'd built this thing. He surrounded himself by people that he'd worked with for a very long time, presumably. Sometimes people would leave the organization because they were ready to do their own thing. Sometimes people just wanted to be the number 2 or the number 3 or the number 6 or whatever. And so you see these organizations, especially long legacy people who've had success together, and in particular become billionaires. And the dynamic is very interesting. And I think as a younger person, it's easier to fit into that culture. And then as an older person, clearly I'm sure if you had been a 10-year hedge fund manager and you showed up at the Y, I'm sure T Boone would have said, there's an NFW that I'm going to bring you in, because you already, I want to train you of all the habits I want you to have. But then there is a time when it comes to go leave and you have to go do something from scratch, and you did. So you started Saltstone in 2016, and the mandate is energy investing.
We are fixated. We call it kind of a relational style of investing. I mean, we want to know the people in which we're investing our capital with. And so when we're stewards or we're fiduciaries. And when you invest $1 into a company, they are inherently going to become the fiduciaries of that dollar that you're investing into that company. So each share represents a partial ownership of that particular business in which you've invested in. So we want to know not only who you are, but we want to know what you've done in the past. We want to know We want to know trials and tribulations. We want to know successes. We want to know all of those things. And then you start diving deep into the nuances of the businesses and from a bottoms up perspective. And where we feel like we differentiate ourselves is utilizing relationships that we're fortunate to be able to have. And I'm sure many of the people might potentially watch this. And so thank you for taking my calls, and I'm grateful for each one of you. And I hope we give some of that back to you as well. But we don't pretend to be geologists nor engineers. I did take a geology course at TCU. It was a beginning stage geology course just because I love the sector. But we do like to know from a geological perspective what the rocks are actually telling you. And so that's what helps us from a risk factor when you're looking at those assets. How should you value those rocks appropriately? And then we build a model based on those particular companies. And we tend to focus on the cash flow stream. We focus on the PDP, the proved developed producing resources that are, that company is essentially drawing down and producing over a period of time. And we value that stream. And then we also look at the potential upside that could be garnered from an incremental well that's being drilled. And then that's what goes into that NPV positive type project. Is this actually accretive to shareholders? And should this project be done?
So it's funny that you started in 2016 and we started One Energy Partners in 2016 as well. And it's the second time in 2 days I've heard about the oil and gas industry has been in a bear market since 2014. And that was certainly, go ahead.
No, that's interesting. Keep going, because I feel like we're the only ones that's been saying that. But
no, I talked to someone yesterday that'll come out in the next week or so, and they also described it as that. And it's really funny because living it as I did, and as I know you did, but certainly as a operator, as a builder of a business, I didn't think about it as a 6-year bear market, and it really opened my eyes to a couple things. Number one, the S&P and the broad sector of the world has not been in a bear market. And the way that it feels to be in a bear market, energy professionals can attest, it is horrible. And so it's also interesting that even though the bear market feels bad, there's times when you don't think you're in a bear market, but it's this concept around bear market rally. And I feel like we've become desensitized based on the talking heads on TV. They're like, oh, it's up 10%, so you're a bull. Oh, it's down 20%, so it's a bear. And they're flipping all these terms, but it's like we were in a secular bear market, which we continue to be in. It's sort of why I think a lot of the projections I have in terms of employment and what's happened to coal. Coal's been in a bear market for 10 years. And I don't think that the psyche of America is ready for a bear market where stocks continue to fall time and time again. Jobs don't exist. Coming out of school, unemployment, just all of that. I don't know if our country is ready for that. And I don't think the politicians understand that the lockdown of the economy guaranteed the depth of the bear market is going to be so much deeper than anything we've ever seen. And so for energy professionals, I feel like we're uniquely qualified to explain the pain that's coming. But how did you...
That a lot. I totally agree. I've been saying that. I mean,
it's great. It's a great insight. It really is. And it's been interesting.
A lot of, you see it, and you see friends that are in different careers and different career paths that were taken, and you see sectors that have obviously performed extremely well. And, businesses are cyclical. Some businesses have more sustainability than others, but energy more so is an incredibly cyclical sector. And one thing, going back to just studying the cycles is, and you alluded to this earlier, but the velocity of returns have changed dramatically because of different phenomenons that have been inserted into the marketplace and different changes that have been impacted in terms of who the actual players are in the financial markets relative to where they were 10, 15, 20 years ago. But when you look at history from a cycle perspective, I mean, these cycles tend to last 10 to 15 years. I mean, think about, you mentioned 85, it took 5 years for you to, it took a war essentially for you to be able to retrace all of the prices in the early 90s that you had dropped from 85, 86. And
it was the Gulf War. I remember it. That was 91 when we were engaged in Iraq and the invasion of Kuwait. Because think I was maybe grade 7. And it is funny, again, I had not thought about that for a very long time, but I remember the first time a missile was fired. And, I was an oil family, and that was the turning point. That was the catalyst that basically made the 90s work for oil. And the Middle East and the geopolitical and oil prices moved up, and I had my first summer job in 97, and oil was $30, and it went to 12 that summer, went through massive bankruptcies, and that was the backdrop to which I was going through school. And yeah, I mean, it does 5 years is right after 1985. And I think a lot of younger people who didn't live through 2008 like you and I did, who didn't live through the 2000 tech bubble. And I think I'm a bit older than you. So I remember, everyone thought they were the greatest investor ever. They could buy a penny stock and be worth 100 times later in a month. And they thought they were brilliant. And that crash was brutal. And energy investors and energy employees feel like, oh yeah, in 6 months, 3 months, this is going to work its way through. But it's been 6 years and it's now changed. So it's like another 5 years potentially. How do you, as an investor in energy, like, we've been in a bear market. I mean, the right strategy obviously was to be short the sector since 2018. And I know Tom Loffrey, who you might follow on Twitter, we've chatted. I'm going to have him as a guest here soon. I promised it. And but he in Q1 2018 went around New York, and he called his presentation "The Big Short in Energy," and everyone laughed him out of the office. And he had to change his entire business plan to build sort of a tech tool because he couldn't raise money. Whereas shorting energy in 2018 would have been the single greatest investment anyone could have done, for a lot of reasons. So how do you survive as an energy focused hedge fund trying to take long positions in an industry that has been a bear market that's almost impossible to win?
Totally. Okay, so full disclosure, we are a long short hedge fund.
Okay.
We have the ability to be able to be short. People have particularly, maybe management teams or other there's a stigma against shorting stocks. And, I did a lot of soul searching years ago about what value does a hedge fund actually bring to the entire equation? And I came to that conclusion. I think it's actually a vital, it is critical that hedge funds are around, because hedge funds and investment managers within hedge funds are doing deep, detailed, fundamental analysis for the most part. It depends what type of hedge fund you are, of course. But they're the ones that are conversing with management teams and really pushing the envelope, right? You talked about that scenario where you were in, BP's, I don't know whatever room it was, right? And you asked a couple of questions and all of them were prodding the business model. And you think that was part of the reason why, and then it was a blessing in disguise because you didn't culturally fit there. But that's what hedge funds do. And so I came to the conclusion that there is a opportunity for respectful hedge funds to be able to respectfully not only glean information from people that have been in the industry for decades longer than I have, but also to maybe bring a different view and a lens to try to see if the model can be altered in a manner to where it's more sustainable for not only energy specialists to invest in, but also ultimately that incremental source of capital into the sector, which is going to have to come from the generalists. And so, I've had a ton of conversations and fortunate to be able to sit down with publicly traded CEOs, CFOs, CEOs, and talk to them about shorting. And we're very transparent. It's not, we're out to go get this company. We're out to do this. We have a fiduciary responsibility, just like they have a fiduciary responsibility. And so when we analyze it, we take all of those emotions out of the equation and we focus on what the math is saying. So when you look at the portfolio for a year and a half, I hate to say this, but the only long we've had was Abraxas Petroleum. And everything else in the portfolio was a short. And so that was very similar to, I know you talk about smog all the time. And I think that the statistics that you came up with is that when you run like 56 and 275, utilize your smog analysis, 95% of the public companies didn't work. Is that roughly correct?
Yeah.
Okay. So when we model these companies, what we came to the conclusion is that we are very detailed in our model and our assessment of, take out the emotions, look at the rocks, look at the geology, look at the engineering of that particular company. How are they efficient relative to another company, right? There's so many different factors and variables that play into this. It's not just a, one company type of a game. You have 9,000 producers. I mean, that's the difference between energy in America relative to energy in Saudi Arabia or Libya or Venezuela or whichever country you want to talk about. 9,000 producers, and 150 of those are publicly traded. And when you include microcaps, it's more like 250. So you've got a huge avenue to scrub. And when you look at the crude developed producing resources and you look at the ability for companies to be what in our opinion was 850 billion of capital in the form of 150 billion of private equity, 150 billion of public equity, and the rest of it was coming up between RBLs and debt, that was put into the system to grow this incremental 4.5 million barrels a day that we saw from the 2016 lows to peak, what appears to be peak 2020, 13 million. We'll see if we ever exceed that again, 13 million barrels a day. And now you're at the point to where it started to shift a year ago with this free cash flow mantra. And dependent upon whatever life cycle is Business School 101, whatever life cycle of a company that you're in, depends upon should that model be growth? Should it be value? Should it be, return of capital back to shareholders? What should it be? So you're at this point now where you had this massive infusion of capital, $850 billion, and you've got shareholders that are sitting there saying, okay, we need some of that. We need a return on our investment now. So in order to get there, you need to be able to be free cash flow positive. And unfortunately, for these businesses, you need to be able to be free cash flow positive as well as grow 3 to 5% roughly. But then you look at the business models, and when we started scrubbing the assets and the rocks and the the unconventional nature of shale from a declines perspective, what we found is that trying to underwrite utilizing decline curves that other companies were displaying in presentations was not the correct approach, because decline curves were much more vast than what was being said. But we would even include their analysis in our analysis to say that that's like the most aggressive scenario you could have, right? So use that, utilize $60 for the next 30 years as our threshold. And we use $2.50 gas, and we don't utilize any dips, but we put the full cost structure into the equation. And then we even start to draw down SG&A as well. And we say that these companies over time will be forced to cut SG&A. And I think you talked about that as well. Like there's an abundance of SG&A that's in the system, which is unfortunate because SG&A is going to translate into jobs, which means that cutting SG&A is going to translate into less jobs within energy, which is something that I'm not trying to pontificate about. This is what needs to happen. My heart is out to those, and it's hard for everybody. It's hard for the buy side. It's hard for the sell side. It's hard for energy companies. It's hard for service companies. Everybody's being impacted in this. So we're there with you. And so when we look at it, we came to a very similar conclusion that you did over a year ago, that 95% of these companies, there's only 5% that actually could generate a return in excess of the amount of debt that they have.
Yeah, and and it's funny, like it allows us to go into so many things. It's going to turn into the Joe Rogan podcast where we're going to have a 4-hour conversation. We're going to need to get some scotch and some weed and do all that stuff like Elon. But
Elon, the energy sector. Look, with the passing away, I loved Aubrey McClendon. People have there's so many different views that you could take. The guy was a freaking pioneer. What Devin saw in the Barnett, he extrapolated every other basin, right? George Mitchell tapped it off in the Barnett, and he said, this isn't just a phenomenon in the Barnett. We're going to take this to Haynesville. He was like, we're going to take this to the Haynesville. We're going to take this to Utica. We're going to go to the Marcellus. We're going to go to the Eagle Ford. We're going to do it in the Permian. And the guy did it, and he opened up. This boom, was essentially spurred by an Elon Musk type character. That's what he was.
I totally agree. And I think we as an industry have been so protective about not having personalities. And look, I don't know Matt Gallagher from Sam, but when I saw the presentation when he was talking about the shale New Deal, it was at NAPE. It was just before all this, and there was no compelling vision for the future. There was no recreation, and our industry, for good or for bad, has not really been innovative in the way, and Tisha Schuler talks about it a lot, and we've had her on the podcast, but like revision the future doesn't just mean, CO2 is not a problem. It might not be a problem, but you have to react to it. And COVID, it might not be a major deal in terms of death rate, fatality rates, et cetera, but the world is locked down, so you have to figure it out. And I feel like the CEOs that we have, with the exception of Vicky Hollab, and so it ties back to the Alabama, but my defense of her is not because decisions were always right. As you said, as I've done, many decisions in our life are wrong. Yep. And the question is, what do you make of them? But coming out and saying, we need to be pioneers in CO2. We need to be pioneers in CO2 net carbon negative. We need to be producing the last barrel. We need to engage our employees. We need to do all these things. Those are hard things for energy CEOs to do, and I would say that they haven't done it. And so, yes, Anadarko will always be a blemish, especially given that the downturn happened. But I think your point, my point in my investment thesis was I believed oil was going to be $60. I think that, as you look at companies now, I mean, how do you value a company in a $26 world with so much storage overhang and demand questions? And the answer is you can't. But how do you value Tesla or Amazon or Google? Because everyone's business model has been blown up. So you make an assumption, you defend your assumption, you be transparent about what it is, and the second it changes, you tell people it changed and you make a new plan. Doesn't mean you always have to be right. So there's a lot that ties into that.
There's a lot in there. Okay, so a couple things. One, I will, to credit to Matt, I think that Matt and Scott Sheffield, I mean, we can put Texas Railroad Commission aside, whatever, we can debate that all day long. I think that was eye-opening for the market. You saw the reaction. You had the President Trump tweet. He essentially rebrokered a deal, brought OPEC back to the table plus Russia. Railroad Commission came together. And I think that the aspects of the business where the business needs to get is being pushed by Scott Sheffield and Matt Gallagher at Parsley at this point in time, right? They've been talking about for a while the need for free cash flow. The problem that we foresee is that you actually need real free cash flow, not like adjusted free cash flow. You need actual cash that's accruing to the balance sheet, and you need to start paying down the abundance of debt. So there is a way to model these companies, and we model them, and we look at them and we assess them. The problem is the vast majority of them took on way too much debt. And now when you look at the landscape as a whole, we calculate that of U.S. shale production, that if you were actually to wipe out, I know this is like a huge hypothetical, but I feel like you kind of like talking in huge hypotheticals. If you wipe out all of the interest expense and essentially just wipe clear all of the debt that has been piled onto the system, the marginal barrel of shale would now be $8 more efficient. For every shale barrel that's produced, it is burdened by $8 of interest expense.
Yeah.
I mean, that is a mind-blowing conundrum that is in the equation, especially when you commingle. So when you're talking about buying the companies, right, access to capital is a critical component to being a publicly traded company. That's why you make the decision to go public in the first place. You want access to the capital markets. So we saw it with Pioneer. They did a $1.15 billion convertible deal. And you saw it with Comstock. And then you've seen a Microcap and Torchlight that's trying to raise $5 million. So 3 deals that have been announced. And the market has rallied 100%. The energy market has. The XOP's up 88%. And going back into the velocity of returns, which is fascinating to think about, Pioneer in 2016, from the lows of 2016, so Jan 15 was, Jan like 20th was, I think, Pioneer's low. Energy bottom February at 2605 of February 2016. Pioneer rallied 88.19% over a 10-month period of time. Pioneer in 2020 rallied 88.19% from the lows to the recent highs over a month and a half. So like you compressed all of this, like now when we look at these companies, the unfortunate truth is unless you're willing to give a ton and underwrite, which, when you're buying a stock, you want to feel like you're buying this where you have a maximum optionality, right? I mean, that's what created the value in the shale boom is you bought a 10,000 net acres. I mean, you could preach this better than anybody can, right? You drill a couple of wells, you create the optionality because now you can show the geology of, hey, look at these uphole potentials. Look if you complete here. Look at the potential resource, the whole 9 yards. And so now instead of expanding that optionality, we're in this period of shrinking, right? So was it going to be 36 wells per zone? Nah, it's probably more like 20. So that's NAV. Like we were talking about the NAV equation now going like, oof. Okay, no, was it 60? Nah, it's 30. Oof. Okay, how much can we take SG&A down? That's going to expand you a little bit. Like all of these things are changing the equation on a daily basis, like you alluded to. But what we foresee is a continual, really challenging patch. In our number, I know you've been talking about less than 200 rigs. We've been saying for the same time, 158 was our rig count level for oil rigs. And the way that we view an oil rig today is, so in 1970s, oil rigs peaked at 4,520. In 2016, October 2016, you went to 1,609 oil rigs. So now you're at this threshold where you've come down drastically. The velocity came down much quicker than anybody ever could have anticipated. And that's because you didn't have long-term contracts, all 9 yards, and it allowed the accessibility and the velocity, which unfortunately translated into less jobs. And when you look at it, these rigs are so much more efficient than they were even 4 years ago. I mean, look at Pioneer's efficiency. Look at their efficiencies from a drilling perspective. It's amazing. You now have the very best crews, the very best rigs, and that's where you unfortunately get in supply overhang scenarios. You get like these, what in the world is happening type of moments. I mean, so now you've got Russia that's building ducts, the United States building ducts, you've got Canada building ducts, Saudi Arabia building ducts. So these are like, almost instantaneous, talking about, I mean, look, spare capacity is defined as production being able to come online in the next couple of months. Well, you're talking about production come online in 6 months. So it's sorry, I know I kind of
no. I mean, and this is what's so cool about this is we did this with Josh Young and others. When you take people who are actually looking at the data and they're not just pontificating in a 280 character tweet behind an anonymous name saying something that's repeating something else, you can hear the depth and level of research and knowledge that goes into everything that you're doing or that I do or that others do is how we face facts and we make a business model that makes a compelling case to put investments behind it. So I love it, and I agree with you. I think the 158 rigs is certainly we come to very similar numbers, even though we got there in different ways. And I think that sort of supports, that's probably where we head. And where I struggle, and I think you started with this too, is on the SG&A side. You and I both know that the only two cash costs that companies can, and I put this in quotes, control, are SG&A, capital to a degree, but there's no project that makes sense in this world with overhang. And so headcount and interest. And the interest, and we've seen this in the CDEV bondholders, and I think we've started seeing hedge funds, and I'd be curious your comments, but hedge funds buying these massively discounted bonds because if you buy the equity, you could be wiped out. And like I would say on CDEV, at a $60 world, I was right. In a $30 world, I was massively wrong. And so the long short strategy would have made more sense. And then you go and you kick yourself and you say, well, how did I not see this coming? Because the assumption was there wasn't a world global shutdown. There wasn't 100 million barrels a day of demand going to 65. And again, the only thing right now companies can control is SG&A. And so they have to cut heads. And I don't think people truly understand how bad that is and how much more cutting there has to be, because it is the only controllable variable, and most employees are spent on the capital program, which does not exist.
You're spot on, and where I'd say it gets even more challenging is reverting back to the 6-year bear market, which means that by theory we've already started to take these efficiencies into account, which means that you've already cut a lot from the system, right? I mean, you look at where EBITDA margins for oilfield service companies were entering June of 2014 and then exiting in February of 2016 relative to where EBITDA margins are entering March of 2020 relative to where they're probably going to exit. Like there was no room for cost to come out on the drilling and complete side, right? No room now in the 2020s. That's all been brought out of the system. So that means that in these next few quarters, E&P companies are likely to be, with the exception of massive restructuring, the most efficient that they could probably possibly be. And that's just from a math perspective, looking at the costs that have already been brought out and what can potentially come out in the future. And, the fastest that you can drill a well, you can only go so fast, right? I mean, the fastest you can complete a well, you can only go so fast. And these guys are freaking amazing. Like, it is amazing to go out there to a pad site and watch it in action. I mean, I love it. That's my favorite thing to do, is to go and do boots on the ground type approach and talk to the people that are actually getting their hands dirty. And those are the people that I love to chill with and glean information and insights from, because they're the ones that are doing it on a daily basis, and they see the pains, the stress, the struggles, and the real life anecdotes that are occurring. The one thing that I will say on, just underwriting these assets, I think where this is going to be really challenging is that we've spent a lot of time looking at the banks and what the banks had been underwriting for a lot of these loans. And we think that, we're not involved. We're not invested in any banks. We're not invested in the financials, the financial sector. But we do look at these loan books, and we look at who they're tied to, and we look at those assets, and we also look at the credit ratings, and we look at how the credit ratings are already modeling commodity prices that are well in excess of where the curve is. So you look at like the S&P, and they're modeling like freaking 35, 45, 55, in longevity, and that's how they're coming up with these credit ratings. So we think that unless the capital markets open up drastically, which we don't have the belief that second round is there. There's $43 trillion of anti-fossil fuel capital signed up globally.
Did you just say 43 trillion?
Yes. That's signed up to never invest in fossil fuels. That's a staggering number. And so when you look at that, and you look at the space where it is today, and you look at pre-pandemic, the rallying cry was, of course, in the form of ESG and global warming. I just think it's really, really tough. And so that means that business models have to get efficient, which sadly means that you're going to have to see massive restructuring.
Yeah. And I mean, I think there's so much headwind that's so different in the anti-fossil fuel movement. And what I've tried to get my head around, and maybe you have a better perspective on it, is like everyone does something to make money. At the core of every decision, even the shutdown, someone is benefiting somehow, even if you can't see it. And so you have all these wealth funds who've signed up for anti-fossil fuels, yep, which is both an investment in new infrastructure, which clearly they own the patents, or they have the carbon, the carbon credits market they own, or they're trying to crush Saudi to get in and do. I don't know what it is, but and how does a recession change that investment thesis, given that first world problems seem climate change, but zeroth world order problems are like feeding yourself and feeding your family and having a job? How do you think that plays out in the next 5 years? I think
it's incredibly complex, in that all you have to do is look at any economist's projections of what the future looks like, and that there's like 100% chance they're probably going to be wrong on those prognostications, which I'm not trying to be rude. It's just at it. So it's important to look at, and it's what everybody bases their analysis off of. So it's critical to look at the data. This is going to seem really dramatic, but I think that there is a likely or a greater chance that you've seen. I mean, and I'm not trying to I hope it's not true, but I think you likely could have seen peak demand. And that it's going to be incredibly challenging, just given the way that the world is shifting. And I know that this is an incredibly debatable topic, but I just look at everybody. We call a lot of people to try to ask, are you going to shift your business model? And a lot of people are saying yes. I mean, we have 3 parking garages, one of which just opened up right behind me in Dallas, in downtown Dallas. This one opened up 2 months ago, literally not a car. Texas is one of the most conservative states. I know Dallas, tends to lean like 55, 45, 55 left, 45 right. But the business owners in the city are largely very conservative. I tweeted out a picture. This is not like a falsified, let me pick a fun, let me get it when no cars are coming. I went to popular spots during the week and nobody's around. This is Thursday of the second week of opening for businesses in the city, and it's crickets.
Yeah.
And so I think that where China is different than the United States, and why we're so fixated on China's data, I think where that could be a little bit misleading is because you have to look at China's ability as a dictatorship to control policies that are instilled in the citizens of that country. And so you look at what transpired, they shut it down completely, right? They put up 6-foot barricades around Wuhan, and they had little slots where the army would essentially deliver food to citizens that were hungry.
Well, they were pulling people out of their families, putting them in hotels, and like literally quarantining with like welding. They had a hotel collapse on people they were quarantining. Like they were, yeah, it was a totally different scenario.
Totally different scenarios. So that's why I think that the trends are not exactly similar, right? Because you had a complete total lockdown, like an actual lockdown. Nobody's going anywhere. This person, and by the way, we're monitoring you because we know exactly, you're barcoded for every single person. We know where every citizen's walking around. We don't have that in America. It's a free economy. Some people are debating whether or not it's actually free now, just given the fact that we've been in a government-led shutdown. But that's neither here nor there. And you look at the data, and I just think that there's going to be a lot of psychological shifts. And it's hard to understand. And Warren Buffett did an unreal job of describing that, of looking at the Great Depression and the fact that for the economy to essentially get back to where it was after the Great Depression, it took decades.
Yeah.
And it was because of the brain, right? The brain changes. Like, take me, like one of the most avid Alabama football fans. Like, I freaking love it. Like, am I going to go to a football game? Like, we already have hotel reserve. We're playing the Aggies at home. And I'm like, I don't know. So, like, that's me as the barometer. Yeah. And like, I fly around all the time. I'm like the last one. I'm like, who cares? Like, it's on the floor. I'll still eat it. I don't care. But now I'm like, So if I'm changing that, like, I'm not the marginal one, It's like, yeah. So that's where I think psychologically is going to be really challenging. It's going to be tough to know, which creates a conundrum once again for energy. And then you could also create that. I think that you've got, thank the Lord, Libya, Venezuela, and Iran at 3-decade low production thresholds. You've got a massive, not only do you have $1 billion worth of extra, storage, barrels in storage, but you also have, countries that are producing at low levels.
And so I think, everything there ties together in the following statement is it's really easy to have hope as a plan. But when you talk about the double whammy that was the March 5th to 9th, and that those who were looking, and again, this isn't trying to be like a grandiose statement of like, so we're smarter, but if you actually pay attention to the data, which you do, which I do, which others do, and you make a thesis that is totally delinked, people think I'm negative energy. I love energy. I mean, I love energy so much that as cynical as I am, as many speeches as I gave for 6 months, that was companies are overvalued. You can't buy anyone. You have to use smog. I still went long only on the relative value plays because I could not bring myself to bet against the industry. I was in a way.
There is. I love it. I mean, it's the greatest people.
It's the greatest people in the world. So we're not trying to be negative. We're just saying like people need to prepare. And so I did a post yesterday on Oxy. It was sort of indirectly about their reduction of force, and that they're basically doing an auction, which I think is brilliant because it gives employees a choice that if you are going to move or retire or whatever in 6 months is what you want to bid, you can bid it. And so you get to control it, as opposed to like one of the two of us isn't going to have a job later and it's you, and I survived. And so, but one of the things I said in there was 80% of oil and gas jobs are going to be lost. And it's going to happen very quickly because of exactly what you said. I didn't think demand was going to peak anywhere near, but I see, if you don't have Alabama football, then all of a sudden, why would someone go to Alabama University? Because that's part of the experience. So now if I'm doing an online school, why aren't I doing that from my parents' basement? So now universities close. So then now there's professors who you've been tenured that don't teach, so that they don't drive because they don't have a job. And so you can shrink the economy so far that we may never get to 100 million barrels a day again. And Art Barman, who I'm sure you follow as well, I think he sort of projected 5 to 10 million of demand destruction. What do you think about that? Where do you think demand levels out in 2 years?
It's a great question. And once again, I revert back to what I said. I mean, we focus, the top down is so intriguing to talk about. What we're fixated on is the bottoms up. And so one thing to be clear on, in January, we started to get a little bit nervous about coronavirus. And early January, we started to run regressions on utilizing what we were seeing extrapolated throughout China relative to what prior pandemics actually panned out to be. And then I started stressing the portfolio to see how our position was based upon those potential scenarios. And what we concluded on, because at that point in time, we were essentially, I hate to say it's all of our positions were short. Like we tell our investors, like, we're not the hedge fund that's trying to do month to month. I think that's more, in my opinion, it's more trading as opposed to investing. We're investors, and we focus on the intrinsic value, and we want to position the portfolio and our investors in a manner in which we have longevity and duration of capital. And we tell them that this investment should be viewed more from the standpoint of an IRR as opposed to a month-to-month or a year type of a return, right? So any investment that you make, you should view it, in our opinion, on an IRR basis. And when you insert that dollar, we think that the velocity of those returns, meaning that if the time is compressed and your IRR is increased, then that's going to be dictated upon more than likely what's out of our control, which is the commodity. And so you look at that, and when we started stressing the portfolio, we were saying, look, I think if it gets as bad as it could potentially get, then unfortunately we're positioned really, really well. And I'll tell you, and this is the truth, on March 7th, which was, the day that March 7th was a Saturday.
Yeah.
March 6th, when we're driving to the office, like, being short, I wasn't saying, like, my heart was literally aching for the people in the space, because it's similar to your discussions that you had. And some people are going to say, oh yeah, that's, not true, but it's truth. I mean, these are my words. I promise you it's true. And it's just really challenging times. And I think it's lost on people that it has been very challenging times for 6 years now. And I think that what's going to be interesting is that now that oil has gone back to this 25 threshold, you're going to start to see production coming back online. You're going to see a response because those barrels are now in excess of what cash costs are. And so it just makes logic. They need to be producing those barrels. It's just an important part of the equation. And so when you look at underwriting these securities and you focus on that, I mean, we still foresee that whether it's demand or supply or whatever happens in the next 2 years, which, like I said, I think that, Art's pontification and his thought process and his specific data points of maybe 5 to 10 million barrels a day of less demand, that could very well be true. I also wouldn't be surprised, because of it just gets me hard. Like, you look at what India is saying, you look at what the United States is saying, nationalism is going to continue to reverberate loudly. You're going to have these countries the nationalist movement began pre-President Trump's election. And more isolationist type events are going to create, in my opinion, an even more challenged environment for oil demand and fossil fuel demand. Natural gas will continue to grow because of power gen, but it's just going to be tough times. And so how that translates, I mean, look, if gas prices are going up because less associated gas, then that's a net beneficiary for renewables, because renewables are going to be competing with gas from a power gen standpoint. So that makes them on the margin arguably more competitive. We do study some of those companies, but we're not invested there. We're all of the above approach. Mr. Pickens has always been that way. That's kind of ingrained in me. I'm a believer that you need every single form in order to be able to power, and you want the most efficient forms of power. And we're fortunate to live in a society, and you look at the correlations between life expectancy relating to how much incremental use of fossil fuels per capita. And our industry is different from tobacco, right? You actually utilize more energy. You actually live longer lives. Tobacco, utilize more freaking tobacco products. You're going to live a shorter period of life. But the business models that we've been saying now for 2 years are very similar to tobacco companies. Synergies, less interest expense, less SG&A, less LOE, more efficient business models will create a free cash flow yielding vehicle that generalists can no longer ignore, just like tobacco companies. There were regulatory risks. There were risks there from perception risk. All of those are risks, right? And at the end of the day, cash matters, and cash is critical, and that will create an industry that'll be sustainable. But then the human nature aspect comes into play, and with human nature and jobs. And if you're somebody that's taking $500,000, $1 million, $2 million of cash out of the business, you have a family to protect. And even though you have a fiduciary duty, maybe the right thing is to sell that company, you're protecting your family and your own personal interest. That's when it takes it much longer for the consolidation period to happen. I think that's the biggest component that I think people probably misunderstand is, it'd be like me coming to you and say, hey, David, I think I can do the podcast better than you. Why don't we just consolidate? You'd be like, no, get out of here. Like, have you seen what I've been doing?
Right.
And
No, it's fortunately we don't get paid here on the podcast, so you can take over, you can take over anytime you want. But I mean, it is interesting. So did you cover your shorts? Are you still positioned short?
We had 6 shorts, and we covered 5 of 6 in March. And, humbly saying, look, this business, like I said, is the most humbling business. It's so hard. But we feel like, unfortunately, there's still a lot of really attractive opportunities, and it's still on the short equity side. And once again, I want to reiterate, it's not like, and I hope, like, the part of the problem of talking about this stuff is you hope that management companies still, will answer your calls. But the truth be told is, I always hold the opinion that I hope if we're short of security and I speak with you on the phone, that your plan is so articulated in a manner to where it is so insightful and altering from, we have to remain the humility to be able to alter our investment parameters if something that we're analyzing is wrong. But I hope that you change our view and we cover that, and we would be along if there's value there. And so that's what I think is a little bit of the misunderstood side of the equation. Is this isn't, us like trying to say, we're just short energy or short shale companies. No, this is, analysis. This is math. And I think there will be a point in time, and I hope that we're able to grow as a business to be able to capitalize on that point in time. You saw Quantum raise $5.5 billion, or they're in the process of doing that. I think there's going to be a phenomenal opportunity, no different than the 80s. And I think one stat, I wrote this down because I wanted you to have it. So in 1979, there were 60 publicly traded companies. In 1987, there were 20. In 1996, there were 74. In 2001, there were 40. Now, in 2019, 2020, you're at like 150, right? The shale boom created the opening of the capital markets, the kind of the tech bubble scenario that you described. And then now you need the compression, you need the consolidation. And then that's where we, loving the sector, we hope we can be really, really involved and underwrite these securities in a point to where everybody's happy and everybody hopefully makes a ton of money, because the cash flow generating opportunity off of these assets is so abundant that it can't be ignored.
Well, I think that is a great place for us to stop. And I think that
you can go Praxis, but
oh yeah, you know what? Actually, that is a great point. I
can't do that, but I loved it, man. This is fun.
Yeah, and the Abraxas, you know what? I'm going to have you back on, and I want to focus on hopefully there will be like a turn. The economy will be opening up, and we can sort of back test some of the comments. But for the listeners, the way I think about these conversations is there is so much gray area in everything that we do, and that regardless of your opinion on whatever the topic is just having an exploration with someone and listening to their point of views should change your mind about something. And that if there's anything I could hope for coming out of the coronavirus, it's that, a byline of an article that you read every morning on your favorite news station that's an echo chamber misses the fact that you and I could have had this conversation. It could have lasted 15 hours only talking about long, short, and the business model. And neither of us would be right. We both make a projection, we both invest in it, and we see where it goes. And I think our society has been dumbed down to the point where we think that all issues can be characterized in a 2-sentence tweet, and that should form public policy. And so I really enjoyed the conversation. It was obviously wide ranging from football to T Boone Pickens and the start of your career, which I think is great advice, to where the energy industry is now and where the pain's coming in the future. And I'm really looking forward to having you back on. I have been, as I said, a fan of yours for a while. And so it's really, really good to get to spend the time with you. So thank you so much for joining us.
Last thing on your comment, because I think it's critical. We think that's a huge opportunity, because one of our aspects towards understanding these assets is listening. There's so much knowledge to be gleaned from getting to sit down to talk to somebody that's been in the patch for decades. And just learning from that and the stresses and the pains and the cracks in the hands. And that's what we love to do, is talk to the real people, talk to the people that are getting their hands dirty, and talk to people that are making the decisions from a leadership perspective. And that helps in our analytical abilities to underwrite securities.
Absolutely. Until next time, you can always follow us on the web at www.hottakeoftheday.com. Send your emails anytime you want. You have my cell phone because it's out there too. And look forward to hearing from you. Until next time, be safe, be good, have a great day. Bye.
Thanks, everyone.